I have new eye-opening studies for SpyT traders. So those of you who are familiar with SpyT trading know it started with a question. What if? What if we knew how the market might open before the end of the trading day today? What could we do with that information if we were 60, 65, 70, 80% correct? Well, we could trade the gap, the overnight gap in the market, and we could amplify it with options. That could lead to some serious gains. So I've been working on a signal for over 3 years, and it works pretty well now. But we've also developed different types of trades along the way, and that's what we're talking about in this video. Oh, and you can find the signal at spytomorrow.com. So rather than just buying a call or a put, going directional, which can produce some amazing gains, especially when the signal is on the mark. However, there are times when the market's changing hourly, overnight, and there's no way the signal can predict news and events that are market changing. And when there's a lot of that going on, we wanted to develop different types of trades. Trades that have hedges, which means they can minimize your losses or even make money if the market goes in the completely opposite direction. The first hedge trade concept that I started playing with was buying 2 calls to 1 put if the signal said up. If the signal said down, I'd buy 2 puts to 1 call. In other words, that other option in the opposite direction was the hedge. It would be going up if the signal was wrong, which would mean it would reduce the loss. That was the idea, starting off basically with a straddle and then having a directional trade based off of the signal. And we buy the calls and puts at the money. There's actually a name for this type of trade. It's a strip and a strap. A strip is bearish, a strap is bullish. And over the summer of 2022, it worked pretty well. I was doing about 25% per month. And that wasn't as much as previous months, but I had a little more stability with my trades with that hedge, and I really liked it. But by the end of the summer, the market was changing up a little bit, and I had actually a couple off weeks. So I thought, let me start looking at other ways to play this approach. And that's when I developed the SpyT A trade, which is really the strip and the strap. I just gave it the SpyT A name, and then the SpyT B trade, SpyT C, SpyT D, and the SpyT S. Now let's look at the first study that I did from the fall of 2022 using those trades. So this is a review of the first study, and there are not as many types of trades in this study. It was done in late September through early November. And as you can see, we have the straddle, which did really well. And it did really well because it was a highly volatile market. And all we need in a straddle is a big move either up or down. The SpyT A trade is favoring a direction, but has a much stronger directional field than the other trades. And as you can see here, it only did about 4%. But if you consider this basic fact, is that only 10 out of the 21 days were up. That means it was only correct about 47% of the time, and it held up pretty well. Here we're using 100% of our capital, and in this trade we're using 50% of our capital. And as you can see, it did even better and held up very well. So something to consider. It's something we consider with directional trades too. Then we have the SpyT B, the SpyT B at 50%. Then we have the SpyT C and the SpyT D. Now the SpyT C I've pretty much just taken out of circulation. I may do some additional studies in the future with it, but for now it's off the shelf. It's not one of my favorite options. I liked the SpyT D and of course the SpyT S, which seemed to be the most stable throughout all of the environments. And then we of course go through directional, which because we were wrong 11 out of 21 times, the directional trade certainly didn't hold up very well, except until we got it to about 20%. And a 20% position size
actually made money during this time frame.
As you can see, those trades were working really well in the fall. I like the SPY TB and the SPY TD, and the SPY TS seemed to be the most stable out of all of them. So I began recommending it more often in my videos and in my webinars, and I thought this was the best approach if you're going to take on the SPY T challenge. And I was wrong. It was a logical assumption, but that was a mistake. After December 2022, the market volatility started to come down a lot. And we know that volatility plays a big role in terms of option premiums and how options react. However, I really didn't realize how much as it relates to these trades until I had more data. As we got into the new year, more people started to contact me saying, you know, this isn't quite working the way you said it was going to work. And this was especially true for the new people who are taking on the SPY T challenge. I encouraged you, use the SPY TS trade. That's the way to go. And other people are just saying, you know, it worked in the fall, but it's just not working now. So I started to dig a little deeper to find some other trades that might be able to weather through a flatter market. Now, during a flatter market, a lot of options traders will sell options. It's a great way to make money because quite often the strike prices just aren't met and you get to keep all that premium. But that's not the game that we play here. We just buy our options in the evening and we sell them in the morning. So I decided to do another study, a few studies, to take a look at these new option strategies as well as how they reacted in a flatter market. Let's take a look.
This study, like the previous study, represents about 1 month of trading, in this case 20 days. So we had 13 up days and then 7 down days. And this number here is a net 2%, meaning we add up all of the greens and subtract the reds. And in this study, we have the straddle and here the strangle, but what is this 75%? Well, in these studies, the 75% or the 50% does not represent percentage of capital that we're risking. Let me show you what it means. 100% means the first option in the money. So, for example, if you use the SPY TA trade, you would buy 2 calls and 1 put if the indicator said up. And you would buy the first call in the money and then a put of about equal value. So let's say the call was worth $400 just in the money. 75% would mean a call of the value of $300 or 75% of the call that's in the money. And half value, of course, would be $200 and 25% would be $100 compared to that first call, which has a value of $400 that's just in the money. And then I match up the calls and puts based off of these ratios. So going back to our studies, we have the straddle, which you can see did okay, didn't do as well as in the last study because the market is not quite as volatile. And so there are a lot of days it didn't make much money. As you can see here, it was up 0.05% and it lost 13% because it really needed a bigger move to make money. Even though it will make money in either direction, there needs to be enough of a move to make that money to make up for that overnight theta decay. And we have the 75% strangle and the 50% strangle, meaning if the call in the money was $400, for a strangle, we would buy a call at $200 and a put at about $200. Then we have our traditional SPY TA trade, our SPY TQ trade, which is a little newer that I'll explain in a moment, and additional trades that are less expensive trades that I'll get to in a moment. But we have our SPY TB and our D and our S, as well as our directional trades and a leveraged ETF at the end. Going back to the SPY TA trade, we know that a SPY TA is 2 calls and 1 put if our indicator says up. For the SPY TQ trade, it is 3 calls up to 1 put down. So if our indicator said up, we would buy 3 calls and 1 put, which is obviously a more aggressive trade. If the indicator said down, we would buy 3 puts and 1 call. Let's go with the SPY TA trade. And as you can see, it's an expensive trade. So I decided to use these other percentages. So I have a SPY TAH trade, which the H stands for half, or the 50%. So again, if the call in the money was 400, I would buy the 200 calls. So that would be 2 200 calls and 1 200 put. And then the SPY TAQ is the quarter, or the 25%. So we would buy 3 $100 calls and 1 $100 put. And the same goes for the SPY TQ. The SPY TQH would be the 3-to-1 ratio, but the H represents half, or 50%. So we would buy 3 $200 calls and 1 $200 put. And as you can see, all of these did pretty well. The straddle didn't do as well, and the strangles not as well as some of the other trades like the SPY TA and the SPY TQ and the variations thereof. The SPY TB did pretty well, the SPY TD did okay, and the SPY TS was reasonable. And directional, not so much, although the leveraged ETF still held its own, not with a big gain, but it's not an options trade.
Some of those new trades look rather interesting. However, if you look at those 20 days, there were days that were over 1% and below 1% loss. And I want to take a look at a flatter environment. And so let's take a look at that.
So this study is also based off of 20 days. However, the difference is there is no day with a gain over 1% or a loss over 1%. So it's a flatter market. So let's see how it all worked out. We've had the explanation of the percentages, and here we look at the straddle, and it lost. That's because there wasn't enough volatility, enough gains. Although we were 70% correct, up days versus down days, meaning we use up days to represent a correct day and a down day to represent a wrong day, we lost money with the straddle, which is a neutral position. The strangles also lost money. The SPY TA still did about 100%. The SPY TAH did very well. The SPY TQ did excellent, 200%. And then, of course, the half and the quarter of the SPY TQ did well also. Now we get into the previous SPY T trades, and we have the SPY TB, which still made money at 42%. But the SPY TD, well, it lost 40%. And our friend, our go-to, SPY TS, lost 11%. Now, of course, the directionals did very well because we were 70% correct. And the directionals did very well. And of course, our leveraged ETF also did well at just under 13%.
Ouch. As you can see, some of my favorites, such as the SPY TD and the SPY TS, really didn't fare so well. So that study mirrors the current environment much closer than the previous studies. And as you can see, some of those favorites, like the SPY TS that we use in the SPY T challenge, are just not holding up. We didn't have that data before, but now we do, and we see that we're going to have to make some changes for the SPY T challenge and many of my future recommendations. Again, obviously I have failed a few people on this, and I don't want this to keep happening. So let's take this a notch down. In other words, an even flatter market, meaning a month where we don't have an up or a down over 0.5%. And let's see what happens there.
So here we are with our 20-day representative market. Now, these are taken from actual days, meaning a day in which the option expiration was 3 days out, and it went up 0.27% at the time that I took the data. And so these numbers are real, although they are not necessarily representative one day after another. Now getting in to see what happened when we didn't allow the gain or the loss to be more than 0.5%. And as we can see, as expected, the straddle still down. There's no volatility. The strangle, 75 and 50, were over 50% down, losing half your money if you were using all of your capital every time you traded. Now let's go over to the SPY TA. Well, there we go. Well, it was slightly, very slight. Basically, it is break even. And the SPY TAH down 13%. Again, this is a very harsh environment. Not only is it not up or down 0.5%, but we were wrong 7 out of the 20 days, or correct 65% of the time. And as expected, the more risky trades lost more money. The SPY TAQ certainly lost the most out of those three. But then we go to the SPY TQ, and it is up. It is solid. And the SPY TQH also still made money in this environment. However, the SPY TQQ did lose money. And then back to our old friends, SPY TB, SPY TD, SPY TS, all lost money. And for those of you who are saying you've lost about 25, 30%, 35% using SPY TS during a low volatility market, well, this confirms you probably weren't doing anything wrong. Yes, you can make money trading the calls and the puts. If we say up and you go down, you have a put that you can trade, and you can trade it for a profit and then follow your call back up. But not everybody is at that level, especially in the beginning. In the beginning, when we're testing this out, doing the challenge, we're using the basic SPY TS. We buy at the end of the day, sell generally first thing in the morning. Now moving on to the directional. Yes, directional was still up. But directional can be tricky too, because there are days it does start down and moves its way up. And if your stop is too tight, you could still end up with a loss. And our leveraged 3 times ETF made about 9%.
So as you can see, the SPY TA trade held up pretty well. Yes, it was break even, but in this environment, I'm pretty happy to see that, especially because the biggest video that I have created, the one with the most views, is about the SPY TA trade, which I started to walk away from during the fall when the volatility was so high, and I saw these cheaper trades like the SPY TB and the D and the S, and I really got involved with them, and I kind of pushed aside the SPY TA. But seeing that it is the workhorse, the one that works over time, that's very helpful. And seeing that the SPY TQ trade works well, and then we know that if we have a little more volatility, this SPY TAH or SPY TAQ and so forth will work really well and offer us some great gains without as much risk. Obviously, we still like directional. If you can handle the big ups and downs, it's not a bad way to go. Just find the right position size for you. Through our studies, we have found somewhere between 15 and 20% is optimal, but you have to work with your comfort zone. And actually, that's the case with all of these studies. We're using 100% capital, meaning if you have $1,000, then we're risking $1,000. So you can cut that percentage gain in half if, say, you use 50% or a quarter of it, 25%. So these are things to keep in mind as you go through the studies and consider which one's right for you. There's actually an option in the studies that I've really not talked that much about. And it was a recommendation from one of our community members, I think in December. And the reason we were talking about this is because our SPY T trades were really not holding over the weekend. The SPY TB, the SPY TS were losing money over the weekend due to theta decay, which can happen and can hurt our trade even if the indicator is correct. So we're looking for other options, and we knew that directional trades held over the weekend. SPY TA trade held well, but he recommended the 3 times leveraged ETF, which mirrors, say, the SPY or the QQQ. and you point either up or down. So it's like buying a call or a put, except you don't have that theta decay over the weekend. And so if, let's say you bought a QQQT, which says, hey, I think the market's going to go up, and it does, say, go up 1%, you would actually make 3%. So it's not a bad way to go for those who want a little more risk, but are still not up to the full swings of the options market, the more conservative SPY-T trader. SPY-T trading, well, it's a very aggressive style of trading, and it's not for everyone. However, these studies help shed light on how the different SPY-T trades act in different trading environments, high volatility and low volatility. And it's really helped me understand which ones I should be recommending more often in the different types of trading environments, and especially for new people who just need something that's going to work whether it is a low volatility or high volatility market. So I have some adjustments to make moving forward, and I'll see you in those next videos.